Stocks pulling back a bit today on the back of hotter than expected economic data. We're still days away from the 2-year anniversary of the bull market, but the S&P 500 surging about 60% in that time. The index also notching 44 record closes this year alone, the latest being yesterday, where the index closed just shy of 5,800. This will be the 13th bull market to the last 2 years since World War II, barring a massive sell-off in the next day. Hopefully we don't see that. So what are the risks for the rally to make it to year 3? Yahoo Finance's Josh Schafer is here with us. So Josh, assuming that we don't see a massive pullback over the next 24 hours, what are the risks that maybe lie ahead here in the third year?
Yeah, I mean, I think risks are in some way kind of always same as ever, right? I was talking to Michael Kantrowitz, the chief strategist over at Piper Sandler, and he laid out basically there's 3 reasons that you get these 10% drawdowns in stocks, right? It's something to do with interest rates, like rising interest rates. We can think about perhaps 2022 and what that did, right? The rise in inflation, rise in interest rates. Maybe it's something with the economy. That would be the rise in unemployment. Maybe the September jobs report sort of quelled those fears a little bit. And then there's number 3, which people always note, which is the shock that we won't know is coming, right? For that, we can think about maybe the pandemic and something that is sort of unforeseen. But right now, looking at this market, I spoke with several macro strategists about this, and they said basically you're just looking at a market that isn't pricing a lot of risks. Yeah. You're seeing earnings growth expected to pick up over the next couple quarters, expected to be very strong next year. You're looking at valuations that are still on the high end of most historical thresholds. So perhaps the risk is just how perfectly priced the soft landing is right now. And Kantrowitz said what that means to him is if we're not going to see PE multiples go higher, so price to earnings ratio, if price isn't necessarily going to get bid higher for AI euphoria or something like that, what do we need? We need stronger earnings. And so where are you going to find stronger earnings? That's kind of one of the key questions right now. And right now, not a lot of strategists feel like that's going to be with the Mag 7. We've talked a lot about the Mag 7 and big tech being a story of slowing earnings growth. Yes, still significant earnings growth, but sequentially slowing earnings growth. So maybe it's more of that cyclical trade, and that's part of what helps keep this thing moving a little bit forward.
Is there still debate out there and amongst the sources that you talk to all the time, Josh, about what phase of the bull market we're in, whether we're late cycle, early cycle?
Oh, 100%, right? So if you think about valuation, Kevin Gordon over at Charles Schwab pointed this one out to me, but if you look using like a trailing PE, and you're looking at the valuation of this market, we've only been this expensive 2 other times, and it was 2021, and it was the dot-com bubble. So that in alone, in a tunnel, in a vacuum, would tell you we're late cycle, or where this bull market is getting old. If you look at the history of bull markets, which our friend Ryan Dietrich over at Carson Group likes to highlight, we're early, right? We're only 2 years in, the average is 5. We're only up 61%, the average is 180% gain. So it's kind of early in the bull market when you consider it that way. Yeah. And so it seems like right now, a lot of the street does see the S&P 500 continuing to chug higher. I mean, you look at the calls we've been talking about over the last couple of weeks. Brian Belsky over at BMO Capital Markets sees 6,000 for the end of the year. That's higher than we are right now. Goldman Sachs coming out last week saying their 12-month target right now is 6,300. That would be about a 10% gain from where we are. Don't think that would be bad, right? So it seems like the key here still is the Fed going to get this right, and is unemployment really not ticking up? That seems like when I talk to people about the different risks and sort of perhaps the most logical one, that seems like the key one. Because also the other flip side of that too would be if you see a significant tick higher in rates. The strategists I spoke with, yes, the 10-year has gone up to 4%. They're not worried about a 4% 10-year. They're worried about maybe something more like a 4.5% 10-year, 4.3%, because that's when we've seen stocks come down. So right now, you're in a solid spot. All of them did mention the election happens next month. So that doesn't mean that we're not going to see volatility and see things fall. But right now, you're in a pretty good position. I don't know. Some people say when you feel good, maybe that's when you shouldn't feel good, right? So maybe I'm saying all of this to say people are too bullish.
I like the optimism feel. Let's end on the optimism. Like, we all want to be a little bit more.
I mean, the S&P 500 is up over 20% each in the last 2 years. Things are good. Sometimes like things are good and you can't make them sound bad.
It's not going to be a straight line higher too. So
there you go.
You're saying.
Zoom out, the Max chart always looks good, Sean.
It's a wave. All right, Josh Schafer, stocks go up. Thank you for joining us to remind us of that. Really appreciate it. Thank you so much.